Welcome dear learners. Today we will start with second part of unit 36 which focuses on role of microfinance in rural India. In the previous lecture we have discussed about the meaning and basic concept of microfinance. We have also discussed about need of microfinance in rural India along with challenges, structure and different organizations participating in the microfinancial sector in India. In this lecture, we will be discussing about role of NABARD, SIDBI and Rashtriya Mahila Kosh. We will also discuss about functions, importance and limitations of microfinance in rural marketing in India. Now, let us focus on some key institutions starting with NABARD, the National Bank for Agriculture and Rural Development. Established in 1982 specifically to address rural credit challenges, NABARD has played a pivotal role in the Indian microfinance landscape. Its most significant contribution is arguably the design and promotion of the self-help group bank linkage program. This started as a pilot project with 500 self-help groups across India. The program operated on flexible guidelines, emphasizing principles like compulsory savings, linking credit amounts to savings, group based decision making for lending, relying on collective wisdom and peer pressure for repayment, and doing away with traditional collateral requirements. NABARD acts as a crucial refinancing agency, providing 100% refinance to banks that lend to self-help groups under this program. Beyond finance, it provides vital policy directions, technical assistance and capacity building support to partner NGOs and self-help groups through various programs. The self-help group bank linkage model has shown considerable success. It fosters regular savings habit, leads to income generation and employment opportunities for members, builds social capital within groups and helps reduce operational cost for banks wanting to reach the rural poor. It has also encouraged better targeting of financial services and demonstrated high loan repayment rates, often dependent on the effective functioning of the partner NGOs. A key focus remains ensuring financial access for marginal populations, particularly financially excluded women. NABARD supports roughly 1 million self-help groups through various initiatives. More recently, NABARD also initiated a bulk lending plan working with partner institutions to develop efficient procedures for large-scale credit distribution to families across the country. Another key player is SIDBI, the Small Industries Development Bank of India. Established in 1990, SIDBI's primary mandate is to promote and finance the small-scale industries sector. It coordinates the activities of various institutions involved in this area. Within its broader role, SIDBI also actively works to meet the credit needs of the poor and supports employment generation, recognizing the importance of micro enterprises. A major initiative in this regard is the SIDBI microcredit scheme launched around 1993. Through this scheme, SIDBI provides financial services, primarily loans, to well-performing NGOs. These NGOs then act as intermediaries on lending the funds to individuals or groups for setting up or expanding micro enterprises. The loan terms are designed for micro level activities. For example, the text mentions individual limits up to 25,000 rupees with repayment period of 1 to 2 years, while the loan to the NGO itself could be a minimum of 10 lakh rupees with a longer repayment period of up to 5 years, allowing the NGO to recycle the funds multiple times. SIDBI charges interest rates typically between 9 to 15% to the NGOs. These funds support a wide range of activities like silk production, poultry, dairy, fisheries, clothing, and various crafts. Crucially, SIDBI also provides capacity building support to strengthen the accounting and management capabilities of partner NGOs, including funding for managerial salaries and training for self-help groups on credit utilization. This support has enabled many NGOs to effectively link with women self-help groups, providing them access to finance that would be difficult through conventional banking channels. The resulting improvement in members' income and savings has led to high repayment rates cited at 92% in the text. To further strengthen its microfinance operations, SIDBI established the SIDBI Foundation of Microcredit that we call SFMC in 1998-99. This foundation operates at a national level with significant funding, an initial corpus of 100 crore rupees to support microcredit initiatives with effective risk management. Finally, let's discuss the Rashtriya Mahila Kosh or RMK. Established in 1993 and registered under the Societies Registration Act, Rashtriya Mahila Kosh has a specific focus providing credit support to poor women and building promotional infrastructure for the informal or unrecognized sector. Its primary goal is to offer financial services, including credit and potentially insurance, to NGOs that are working with underprivileged women. Rashtriya Mahila Kosh provides loans to various intermediary organizations like NGOs, women development corporations, and cooperative societies, which then use these funds for entrepreneurial activities within the community. The loans are typically small, short to medium term amounts. The text mentions 7,500 rupees per individual, which aims at empowering women economically. Rashtriya Mahila Kosh also specifies interest rate ceilings for its partners, for example, up to 12% charged by the NGO to the self-help group and potentially up to 17.8% charged by the self-help group to the end borrowers. Rashtriya Mahila Kosh actively promotes the stability and growth of women's self-help groups. One notable scheme offers NGOs an interest-free loan up to 1 lakh rupees for forming 25 self-help groups, which can be converted into a grant if the self-help groups are formed successfully with regular savings and internal lending. Rashtriya Mahila Kosh also recognizes the importance of training and encourages participation in microfinance activities. It has developed specific schemes like the Umbrella Scheme and Nodal Agency Scheme to improve the effective delivery of funds. The success of microcredit delivery through Rashtriya Mahila Kosh and its partners, particularly self-help groups, contributed to the idea of developing a national level microcredit body established under the Ministry of Women and Child Development with an initial corpus of 31 crore rupees. Rashtriya Mahila Kosh demonstrated significant outreach by July 2006. It has disbursed around 151 crore rupees, assisting over 5.5 lakh women. It reported loan recovery rate of 91% is notably high, highlighting the effectiveness of its targeted microfinance model. Having looked at the participants, let's examine the functions of microfinance or the different approaches adopted by institutions to deliver these services as described in the text. We can see three main functional approaches. First, there's a direct focus on microfinancial services. Here, organizations like NGOs and specific type of cooperatives such as those registered under the Central Cooperative Societies Act serving women's network concentrate exclusively on encouraging savings and providing necessary funds or credit directly to the underprivileged population, particularly in rural areas. NGOs often integrate lending with savings mobilization. Second, microfinance often serves objectives beyond pure finance. Many organizations, including NGOs and self-help groups, leverage their financial interactions to create awareness about crucial social issues like health, environment, and education. These are sometimes called add-on activities. Even institutions categorized as non-banking financial companies might be involved in or facilitate such broader developmental objectives alongside their financial operations. Third, some institutions function actively as intermediary or support organizations. These entities provide indirect microfinance services by supporting smaller frontline institutions. Examples include apex bodies like the Rashtriya Mahila Kosh, the Rashtriya Gramin Vikas Nidhi, and the SIDBI Foundation for Microfinance. They channel funds or provide capacity building to grassroots organizations. This category also highlights the vital role of informal self-help groups. While often considered non-formal organizations, self-help groups effectively function like microfinance providers, mobilizes savings, offering credit for production, consumption, housing, and other needs, and even providing risk management services like insurance and facilitating market access for their members' product. Finally, let's consolidate the importance of microfinance in rural India. Microfinance is a critical tool for addressing key challenges like poverty, financial exclusion, and gender inequality in India's vast rural landscape. First, it serves as a foundation for rural finance. In areas where access to regular banks is limited or non existent, microfinance provides essential services like small loans and savings account. This is crucial given the significant rural urban divide, widespread rural poverty, and the seasonal, often unstable nature of agricultural income, which makes assessing traditional credit difficult. Microfinancial institutes step in where traditional banks hesitate due to perceived risk or lack of collaterals. Second, microfinance plays a direct role in poverty reduction. By providing microloans, it empowers households living below the poverty line to start small businesses, invest in agricultural inputs, or engage in micro enterprises like weaving or dairy farming. This fosters self sufficiency and reduces reliance on high interest informal money lenders. Third, it significantly promotes financial inclusion. Many rural individuals are excluded from formal banking due to factors like lack of documentation, low literacy level, or geographical remoteness. Microfinance offers accessible financial services including savings, insurance, and crucially financial literacy training. This allows households to manage risk better, plan for the future, and achieve greater economic stability. Fourth, microfinance is vital for supporting rural entrepreneurship. It provides the necessary capital for rural individuals to start and grow small businesses ranging from local retail shops to small food processing units or artisanal crafts. These ventures not only provide livelihood to the entrepreneurs but also create employment opportunities for others in the community, fostering local innovations and diversifying rural economies. Continuing with the importance of microfinance in rural India, fifth, one of its most profound impact is on women's empowerment. Rural women often face significant social and economic exclusion. Microfinance programs frequently target women, recognizing their reliability and their crucial role in family and community well-being. Access to finance allows women to generate their own income, improve their family's living standards, often prioritize spending on education and healthcare, and gain greater confidence and decision making power. Participation in self help groups further provides a platform for solidarity and collective action. Sixth, microfinance contributes to strengthening community development. It's not just an economic tool but also a social one. The self-help group model promotes shared decision making, mutual support, and accountability. Group meetings often become forums to discuss and address broader community issues like health, education, or sanitation, sometimes leading to collective projects that benefit the entire village, thereby enhancing social cohesion. Seventh, it plays a role of modernizing agriculture. Given that agriculture is the primary occupation in rural India, microfinance helps farmers overcome challenges by funding investments in modern farming techniques, better irrigation systems, or higher quality seeds and inputs. It can also encourage the adoption of more sustainable agricultural practices. Finally, by fostering local economic activities and creating sustainable livelihoods, microfinance can contribute to reducing rural urban migration. uh, when people have viable income generating opportunities in their own villages, the economic compulsion to migrate to urban centers in search of work diminishes, helping to prevent the social fabric of rural communities. While microfinance offers significant benefits, it's crucial to acknowledge its limitations, especially provided in context to rural India. First, a common concern is high interest rate. Compared to conventional banks, microfinance institutes often charge higher rates. They justify this by citing high operational cost, particularly when serving remote areas. However, for borrowers with low or unstable incomes, these high rates can create significant financial stress and potentially lead to a cycle of debt. For instance, repaying a 10,000 rupees loan at 25% interest can be incredibly challenging for someone relying on seasonal agricultural income. Second, there's a risk of over indebtedness. Paradoxically, the availability of microcredit can sometimes lead borrowers into taking loans from multiple sources. Perhaps several microfinancial institutes or informal lenders, often just to manage existing repayments. This can quickly spiral into a debt trap, worsening the borrower's financial situation instead of improving it. Factors like inadequate credit assessment by some microfinancial institutes, pressure on borrowers to repay even during difficult times, and low financial literacy contributes to this problem. Third, despite expansion, limited outreach in remote areas remain a challenge. The most geographically isolated villages, often with poor infrastructure and connectivity, tend to be underserved by microfinance services. Ironically, there are often the populations who could benefit more from financial inclusion. High operational cost, difficulties in finding and retaining skilled field staff, and logistical hurdles in loan disbursement and collection make serving these areas difficult for many microfinancial institutes. Fourth, poor financial literacy. Among borrowers, it is significant hurdle. Many individuals in rural areas may not fully grasp contents like compound interest rates, complex repayment schedules, or the implications of defaulting on a loan. This lack of understanding can lead to mismanagement of borrowed funds, unrealistic expectations, and poor decision making regarding debt. Integrating effective financial literacy training with microfinance services is essential. Fifth, microfinance often prioritize credit over other financial services. While effective at providing loans, many initiatives struggle to offer a comprehensive suite of services like secure savings account, affordable insurance such as crop insurance vital for the farmers, or pension products. This lack limits the ability of rural households to manage risk effectively and build long-term financial security. Sixth, there is often a high dependence on the group lending model. This model, where small groups are collectively responsible for loan repayment, does reduce risk for the microfinancial institutes and encourages accountability. However, it can lead to undue peer pressures, compelling individuals to repay loans even when facing severe personal difficulties just to avoid letting the group down. It may also inadvertently exclude individuals who are socially isolated or unable to join a group. Lastly, there is often a lack of customized product. Rural households have diverse financial needs, yet many microfinancial institutes tend to offer standardized loan products. There's a need for greater product innovation to offer more flexible options such as repayment schedules aligned with agricultural cycles or loan specifically designed for diverse non-farm activities. Continuing with the limitations. Seventh, insufficient regulation and oversight has been a concern. The rapid growth of the microfinance sector sometimes outpaced the development of comprehensive regulatory framework. This lack of strong oversight has, in some instances, allowed for unethical practices like overly aggressive loan recovery tactics or non-transparent loan terms, potentially harming borrowers and undermining trust in the sector. Eighth, the challenge of seasonal and unstable rural income cannot be overstated. Heavy reliance on agriculture makes household incomes highly unstable to factors like weather patterns, fluctuating market prices, and pests. Rigid microfinancial institute repayment schedule can become extremely difficult for borrowers to meet during off season or following events like crop failure, pushing them further into debt. Ninth, there is often a limited focus on broader enterprise development. While microfinance provides crucial credit, it frequently lacks the integrated non-financial support that entrepreneurs need to thrive. This includes business skill training, mentorship programs, and help with accessing markets. Without this holistic support, the risk of business failure remains high, limiting the long-term developmental impact of the credit provided. Tenth, social and cultural barriers within rural communities can impede the success of microfinance initiatives. Even though women are often the primary clients, traditional gender norms might restrict their ability to fully engage in or control income generating activities. Similarly, caste based discrimination can unfortunately prevent individuals from certain communities from accessing microfinance services or participating fully in a group activity. Now, let's briefly sum up the key points covered in this unit on the role of microfinance in rural India. We have learned that microfinance essentially means providing access to financial services, primarily credit, but also savings, insurance, and transfers for low income population, particularly those excluded from the formal banking system. It serves as a vital tool for poverty alleviation and overall rural development. We have discussed the diverse organizational participants, including NGOs, self help groups, various forms of cooperatives, specialized non banking financial companies, and crucial apex support institutions like NABARD, SIDBI, and the Rashtriya Mahila Kosh. The importance of microfinance is multifaceted. It empowers households, especially women, by providing resources to start or expand small businesses, thereby boosting income and creating local employment. It promotes financial inclusion, fosters entrepreneurship, supports the modernization of agriculture, and strengthens community development through models like self help groups. However, as we just discussed, microfinance is not without its limitations and challenges. Issues like potentially high interest rates, the risk of over indebtedness, difficulties in reaching the most remote areas, low financial literacy among borrowers, insufficient regulations in some cases, and non financial business support must be acknowledged and addressed. In conclusion, microfinance holds immense potential to create a revolution in rural India, empowering individuals and communities and bridging economic gaps. Realizing this full potential requires a continued commitment to responsible lending practices, ongoing innovation, perhaps leveraging digital technology, supportive regulatory frameworks, and a holistic approach that combines financial services with necessary capacity building and support. Dear learners, I hope by now you have a clear vision about microfinance and its role in rural marketing in India. We have learnt about the meaning and basic concept of microfinance along with understanding the need of microfinance in rural India. We have also gone through the challenges, structure, and different organizational participants in the microfinancial sector in India. We have also known about the role of NABARD, SIDBI, and Rashtriya Mahila Kosh, along with the functions, importance, and limitations of microfinance in rural marketing in India. I believe that you have enjoyed learning about the role of microfinance in rural India. Thank you for your kind listening.